Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at ZIM integrated shipping services.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Yeah, and before we jump into the numbers today, just a quick reminder for you all. We are using StockOracle to help guide our analysis.
Right, which is an incredible AI-aided stock research platform.
Exactly. And there's a special 14-day trial link for it down below in the description.
Yeah, and just to be fully transparent, that is an affiliate link, so the channel may earn a commission if you use it, but that is at absolutely no extra cost to you.
Always good to mention. And, we have to throw in the standard disclaimer here. StockOracle's AI insights and their valuation estimates, they can be incomplete or even wrong.
Yeah, it's a tool, not a crystal ball.
Right, so always verify the important facts yourself. It is not financial advice, it's not a trading signal service, and it's definitely not providing real-time market data. We are just analyzing the landscape.
And we never tell you to buy, sell, or hold. We are just here to break down the upside and the downside so you can make your own decisions.
Exactly. So with that out of the way, let's talk about ZIM, because this one is, well, it's a wild ride.
Oh, man, it is. So imagine you're looking at a company, right? And they just reported that their revenue plummeted by 30%.
Ouch. Right.
And they swung from this massive profit down to an $86 million net loss. Like, their profit margins just basically vaporized overnight.
Just completely gone.
Yeah. If you saw that earnings report, you would naturally assume the stock is just sitting in the gutter, right? Like, institutional investors are just dumping it. Bad numbers equal bad stock performance.
Right, that's the logical conclusion. Cause and effect.
Exactly. But then you pull up the chart for ZIM integrated shipping services, and the stock is actually up 69% over the past year.
Which is just, it defies traditional market logic on almost every single level.
It really does.
You're basically looking at one of the most dizzying financial paradoxes on Wall Street right now.
Yeah.
It's this complete disconnect between the backward-looking financial reality and this crazy forward-looking market optimism.
Yeah, and that's exactly what we need to figure out today for your wealth-building context. Like, how does a stock rally so aggressively when the underlying earnings are falling off a cliff?
Right. What is the market pricing in that these brutal Q1 numbers are just totally missing?
Yeah, but I feel like to understand the optimism, we have to first look at the undeniable damage in that first quarter, right?
Yeah.
You can't really measure the bounce until you measure the crater.
And the crater is deep, let me tell you.
It is.
If we look at the raw fundamentals driving that $86 million net loss
Yeah.
in Q1 of 2026, the primary culprit is this massive, just brutal deterioration in operating income.
Yeah.
They went from generating a positive $464 million a year ago
Oh, wow.
straight down to an $18 million operating loss.
That's a swing.
Yeah, it's huge. And for you listening, if you hold the stock, that essentially translates to their diluted earnings per share dropping from a really healthy $2.45 all the way down to a 71-cent loss per share.
Man. And overall revenue fell to what, 1.40 billion?
Yeah, $1.4 billion.
And when you look at the mechanics of why that revenue dropped so sharply, we're seeing compression from both sides of their business model. It's like, it's a volume issue, but it's also a pricing issue happening at the exact same time.
Which is the worst case scenario.
Right. The actual volume of goods they carried fell 8% down to 866,000 TEUs.
Right, 20-foot equivalent units, basically shipping containers.
Yep, for the containers. But here's the thing, an 8% volume drop doesn't entirely explain a $400 million swing in operating income.
No, not at all.
The real damage, like the actual bleeding, is on the pricing side. The average freight rate they were able to charge for each of those containers dropped a staggering 26%.
Down to $1,310.
Yeah.
And that 26% drop, that is the absolute core of the fundamental breakdown here.
Because of the fixed costs, right?
Exactly. Shipping is an incredibly capital-intensive industry. The fixed costs are massive. Think about it. It costs roughly the same amount of money to operate, staff, and fuel a giant container ship, whether it is 100% full or 80% full.
Right.
And it costs the same whether you're charging top dollar or offering some massive discount rate. Your overhead is rigid.
Yeah, the ship still has to cross the ocean.
Right. So when your pricing power drops by a quarter, you don't just lose 25% of your profit. Your margins completely evaporate. The revenue just isn't there to cover that inflexible overhead.
which perfectly explains the immediate damage we saw to the balance sheet. I mean, ZIM's total cash position dropped to $2.54 billion, while their net debt actually rose up to $2.93 billion.
Yep.
And this actually leads to a metric that I really, really want to challenge you on because, honestly, it's driving me crazy.
Okay, let's hear it.
I'm looking at their trailing price-to-earnings ratio, the PE ratio, and it is sitting at 32.48.
Ah, yeah, the PE.
That makes zero sense. A 32 PE is what you expect to see on, like, a high-growth Silicon Valley AI startup.
Right.
How does a highly cyclical shipping company, one that is literally bleeding cash with a net margin of 1.56%, sustain a multiple over 32? Are investors actually paying a massive premium because they think this is some hyper-growth tech company?
I completely understand the reaction, but it's a classic trap when you rely purely on trailing metrics in a cyclical industry.
Okay.
That 32x PE,
Yeah.
that is not a growth premium. It's actually just a mathematical optical illusion, and it's created by the exact collapse we just talked about.
Wait, hold on. You're saying a 32 PE isn't a premium, it's just a math glitch?
Pretty much.
Because, wait, if earnings drop to a penny, even a $3 stock looks wildly expensive on paper. Is that what's happening here with the denominator?
That is precisely what's happening. I mean, the PE ratio is just the stock price divided by the earnings per share, right?
Right.
So when a company's earnings in the denominator in that equation shrink down to almost zero, which is exactly what we see with that razor-thin 1.56% net margin warm,
Oh, I see.
then literally any stock price at all is going to make the resulting ratio mathematically explode.
Wow.
Yeah. So the market isn't paying 32 times earnings because they expect tech-level growth. The ratio is just broken because the earnings have essentially vanished.
Okay, well, that makes perfect sense of the PE illusion. But what about the debt trajectory? We went from a net leverage ratio of 1.3x up to 1.7x.
Right.
Now, I know 1.7x isn't a total death sentence, especially considering ZIM has invested a ton into modernizing their fleet. But it feels like the direction is the real problem here.
Sure.
Leverage going up while operating income goes negative, I mean, that's a ticking clock, isn't it?
Yeah. It absolutely requires close monitoring. A 1.7 leverage ratio for a capital-heavy business is totally manageable in a vacuum. But the issue, like you noted, is the vector.
Right.
If you are taking on more debt to cover operational shortfalls instead of funding expansion, you are actively eroding shareholder value.
Exactly.
But here's the catch. The market is fully aware of this Q1 fundamental reality. They know the margins compressed, they know the debt ticked up, and they know the earnings vanished.
Yet the stock has rallied 69% from its October 2025 lows.
Exactly.
Which means Wall Street is clearly looking past this brutal first quarter, and they're betting heavily on something structurally advantageous in the future. So let's look at the catalysts. Where is this forward-looking upside actually hiding?
The upside is anchored in two very distinct structural advantages, things that give ZIM a unique agility compared to their legacy competitors.
Okay.
First, we really have to look at their fleet composition. Right now, 40% of ZIM's fleet is LNG-powered capacity, liquefied natural gas.
Now, I know the shift to LNG is this major environmental push across the whole shipping industry, but this isn't just about meeting emissions regulations, is it?
No, not at all.
Like, there's a deep financial mechanism at play here with their supply chains.
That is the real advantage.
Yeah.
Being green is basically just the byproduct. The competitive moat is the fuel economics.
Interesting.
Yeah, ZIM didn't just build LNG ships. They went and secured a long-term supply agreement with Shell on highly, highly competitive terms.
Oh, wow.
And fuel, or bunkering costs, as they call it in the industry, is one of the most volatile and expensive line items for any shipping company.
Of course.
So by locking in a massive portion of their fleet to predictable, competitively priced LNG contracts, they insulate themselves from the wild swings of the conventional oil markets.
Oh, that's smart.
Yeah, it gives them cost visibility where all their competitors just have chaos.
Okay, so a 40% LNG fleet heavily hedges their operational costs. That's catalyst number one. What is the second structural advantage?
It is their revenue strategy, specifically on their trans-Pacific routes.
Okay.
The shipping industry basically operates on two pricing models. You can either sign long-term contracts with massive enterprise clients, so you're locking in a set freight rate for a year or two,
Right.
or you can sell your cargo space on the spot market, where prices float daily based on immediate supply and demand.
Just whatever the going rate is that day.
Exactly. And right now, on those crucial trans-Pacific trade routes, ZIM has roughly 60% of their volume contracted.
Okay.
But the remaining 40% is fully exposed to the daily spot market.
Wait, let me jump in here, because keeping 40% of your volume exposed to a daily spot market sounds less like a structural advantage and more like a massive vulnerability.
Really? How so?
Well, I look at contracts like buying an airline ticket for Thanksgiving, but you buy it 6 months in advance.
Okay, yeah.
It's safe, you know exactly what you're paying, you're locked in. The spot market is like walking up to the airline counter on the day of a massive blizzard and trying to buy a ticket.
That's a good analogy.
You might get a wild discount if the plane is completely empty, but you are way more likely to pay triple the price. Doesn't that level of exposure just invite dangerous volatility into their cash flow?
It introduces extreme volatility, yes. But in global logistics, agility is often way more valuable than stability.
Really?
Yeah, think about it. If you are locked into a 2-year contract and global shipping rates suddenly triple because of a supply chain shock,
Oh, I see.
you don't capture any of that upside. You are forced to carry that cargo at the old, cheap rate, even while your operational costs might be rising.
Ah, so they are essentially trading guaranteed revenue for the ability to react immediately to market panic.
That is the exact trade-off. And management recently noted a highly positive trend on the Trans-Pacific trade. They are seeing strengthening demand and, crucially, rising freight rates.
Okay.
Because ZIM has that massive 40% spot exposure, they can instantly capitalize on those rising rates. They don't have to wait for their old contracts to expire next year. They just charge the higher premium tomorrow.
Wow. Okay, so if that momentum continues into the second half of 2026, that spot exposure transforms from a massive risk into this powerful financial engine, right? Just driving cash straight to the bottom line way faster than heavily contracted peers.
Exactly. That's the bullish thesis right there.
Just see the appeal. You have the LNG hedging your costs on the downside, and the spot market giving you unlimited upside on your revenue.
Perfect setup.
But, and this brings us to the bear case, that entire thesis relies on a relatively stable geopolitical environment. And right now, global supply chains are dealing with anything but stability.
Yeah, it's pretty messy out there.
We really need to talk about the external pressures that ZIM absolutely cannot control, specifically the conflict in the Persian Gulf.
Right. And looking purely at the economic shockwaves from the Persian Gulf, the disruptions are creating this massive macroeconomic headwind that is just dominating the entire shipping sector.
Because they have to reroute, right.
Exactly. The rerouting of ships to avoid the conflict zones adds massive delays. But more importantly, it creates sharp, sudden spikes in conventional bunkering costs.
Which immediately tests that LNG advantage we were just praising,
Yep.
because the 40% LNG fleet is insulated, sure, but that still leaves 60% of ZIM's fleet burning conventional fuel, and they are fully exposed to these geopolitical price shocks.
And the company has been very transparent about this risk, to be fair. Management explicitly warned that these spiking fuel costs are going to hit their balance sheet hard in the second quarter of 2026.
Okay, so the pain is coming.
Yeah. Now, the standard industry practice is to pass these elevated costs onto the customers through what they call offsetting surcharges.
Right, but implementing surcharges isn't instantaneous, is it? Like, you can't just send a mass email to thousands of global enterprise clients on a Tuesday and demand they pay a 15% fuel premium on Wednesday.
Not at all. The logistics of surcharges create this brutal timing gap. I mean, contracts have clauses, regulatory notices are required, and enterprise billing cycles just move slowly.
Yeah.
So when fuel prices spike due to a geopolitical event, the shipping company has to pay that higher cost immediately at the port just to keep the vessels moving.
Right. They need the fuel today.
Exactly. That cash burn hit ZIM's balance sheet today.
Right.
But the extra revenue from those offsetting surcharges, they might not collect that for 3 to 6 months.
Oh, man. That creates a massive cash flow canyon right in the middle. The costs absolutely skyrocket, but the revenue to cover it is delayed by an entire quarter or more.
Exactly.
This is what makes pricing a stock like this so incredibly difficult. I mean, if tensions in the region ease tomorrow, bunker costs drop, the surcharges eventually roll in, and ZIM's margins look incredible.
Yep.
But if tensions escalate further, costs explode, the surcharges can't keep up, and their cash just gets decimated. How is an investor supposed to confidently build a thesis around geopolitical chaos that literally no one can predict?
Well, they can't. Which is why institutional money often anchors to structural catalysts that they can actually measure.
Okay.
And for ZIM, the most significant structural catalyst on the board right now is the pending transaction with Hapag-Lloyd.
Ah, yes. This is the wild card that could completely alter the landscape.
It is massive. A partnership or transaction with a giant like Hapag-Lloyd isn't just about, sharing a few boats.
Right.
It is about deep network integration. It allows the companies to optimize routes, share terminal access, and drastically improve capacity utilization without having to spend billions of dollars physically building new ships.
Which fundamentally alters ZIM's competitive positioning on a global scale.
Completely.
But it's not a done deal yet. We know it has cleared the regulatory hurdles in Australia, which provided a really nice boost to the stock recently.
Oh, that's good news.
But it is currently stalled, waiting for crucial regulatory approval from the state of Israel.
Which makes it a binary event. And the market, it abhors uncertainty, but it loves a catalyst. If the deal is approved, ZIM instantly unlocks operational efficiencies that totally justify a higher valuation. But if the regulatory body in Israel blocks it, that potential vanishes overnight.
And a significant portion of the premium currently baked into that 69% rally probably evaporates right along with it.
Highly likely.
This perfectly sets up the tension we're seeing in the market right now. You have Wall Street trying to digest this tug of war between terrible Q1 fundamentals, unpredictable geopolitical fuel risks, and then this massive structural optimism regarding spot markets and the Hapag-Lloyd deal.
That's a lot to weigh.
Let's look at how the technicals and the sentiment are actually reacting to this stalemate.
Okay, so currently the technicals show a stock that is basically taking a breather.
Yeah.
The price is consolidating around $26.90.
Yeah.
Now, that is a massive recovery from its October 2025 low of $12.33.
Right.
But the short-term momentum is cooling off entirely. If you look over the past 13 weeks, the return is actually negative 3.38%.
Just kind of going sideways to slightly down.
Exactly.
And from a pure valuation standpoint, it trades with a price-to-book ratio of 0.83. Now, for context for you listening, that means you can currently buy the stock for less than the literal liquidation value of its physical assets.
Right.
Its ships, its terminals, its cash.
Yeah.
That isn't entirely uncommon for shipping companies during cyclical downturns, but it does sort of establish a theoretical floor for the stock price.
Yeah, it limits the downside in theory, and the broader media and analyst sentiment is leaning mildly bullish to neutral right now.
Okay.
In fact, our research highlights a recent discounted cash flow estimate, a DCF model, suggesting the stock might actually be 25% undervalued at these current levels.
Wait, I have to stop you there. Because how can a sophisticated financial model claim a 25% undervaluation when we just outlined collapsing freight rates and rising debt?
Yeah, it sounds crazy.
Are they just blindly forecasting a miracle?
No, but this gets to the core of how models treat highly cyclical industries.
Okay, explain that.
So a DCF model projects future cash flows and discounts them back to the present day. When an industry like shipping hits a trough, when rates are abysmal and companies are losing money, the model often assumes a massive reversion to the mean. It assumes that supply chains will eventually self-correct, older ships from competitors will be retired, capacity will tighten up, and freight rates will inevitably bounce back to historical averages.
So the model isn't predicting a miracle, it's just enforcing a mathematical cycle.
Exactly. It heavily penalizes the current depressed earnings and heavily weights a theoretical future recovery.
So it's math based entirely on the assumption that history always repeats itself.
Pretty much.
But here is the massive yellow flag that contradicts that 25% undervaluation theory.
The insider.
The insider activity is terrible. Over the past 90 days, there have been 0 insider buys and 5 distinct insider sells totaling 61,000 shares.
Yeah, that's not great.
If the financial models say the company is drastically undervalued, why are the executives who actually run the business actively selling their stock?
That is the ultimate reality check. And honestly, it's why the overall investment rating lands on a firm neutral or a score of 5.
Yeah.
Theoretical models look 10 years into the future, right? Executives look at next quarter's headaches.
That's a great point.
While 61,000 shares isn't exactly an institutional dump, the ratio of 0 buys to 5 sells shows a distinct lack of internal conviction at these current price levels.
Definitely.
If the people managing the day-to-day operations truly believe the stock was fundamentally mispriced by 25% to the downside, they would be buying. The fact that they aren't tells you everything you need to know about the near-term risk.
Which brings us to the final verdict and the most important date on the calendar. The ultimate catalyst is staring us right in the face. August 19th, 2026.
The Q2 earnings release.
Yep. This is where all the theories, the DCF models, and the geopolitical fears finally hit the actual ledger.
August 19th is the proving ground. And based on everything we've unpacked today, there are two specific metrics the market is going to be dissecting the absolute second the report drops.
Okay, what's the first one?
First, the freight rate. Did the average rate per TEU stabilize above the $1,400 mark?
Right. Because if it is still bleeding down below that $1,310 level we saw in Q1, it means the core fundamental story is still breaking down regardless of how agile they are in the spot market.
Exactly.
And the second metric has to be the fuel costs, right? Wall Street needs to see if those offsetting surcharges actually worked.
Precisely. The market knows Q2 will bear the brunt of the Persian Gulf bunkering spikes.
Yep.
The question is whether ZIM successfully bridged that timing gap and passed those costs on to the enterprise clients, or if they were forced to just eat the losses to maintain market share.
And if they report an operating loss wider than $18 million, and that leverage ratio ticks up closer to 2.0, the narrative could turn aggressively bearish very quickly.
It could. But on the flip side, if they show that the spot market agility paid off, if rates recovered on the trans-Pacific routes, and they successfully navigated those fuel spikes, the narrative instantly shifts from a cyclical struggle straight back into a proven recovery trajectory.
It really leaves the stock in a perfect stalemate today. The market has priced in a structural recovery that the actual audited financial reports just have not yet confirmed.
Yeah, and evaluating ZIM right now really is a masterclass in volatility. You are looking at a highly cyclical play driven by elements completely outside of management's control.
Totally. From global conflicts dictating fuel prices to regulatory bodies in Israel deciding the fate of a massive network expansion. The risk and the reward are locked in a holding pattern.
Until we see the actual numbers in August, any aggressive move is essentially a geopolitical and regulatory gamble.
It really is. It leaves you with a lot to think about regarding how we even measure value in modern markets. And I actually want to leave you with a final, slightly provocative thought to mull over on your own regarding all of this.
Okay, let's hear it.
We live in an era where global supply chains are facing constant, unprecedented disruption.
Sure.
You have geopolitical conflicts rewriting shipping lanes literally overnight, and massive environmental regulations forcing incredibly expensive shifts to technologies like LNG.
The landscape is shifting under these companies daily.
Exactly. The physical reality of moving goods is harder now than it has been in decades. So in a world that chaotic, are traditional backward-looking valuation metrics like PE ratios becoming completely obsolete for the logistics sector?
That's a huge question.
Are we entering a paradigm where measuring a company's pure adaptability, like their spot market exposure, their fuel flexibility, their network agility, is actually the only metric that truly matters for long-term survival?
Well, if the underlying environment is always chaotic, then agility is your only real fundamental.
And if that's true, maybe the old mathematical logic really has been thrown out. Because when you are constantly navigating a hurricane, staring at a broken compass isn't going to save you. You just have to be the best at adjusting your sails.
Yeah. We will see exactly how well ZIM adjusted theirs on August 19th.
Absolutely. And as a reminder, our overall long-term view rests at a neutral score of 5 until those numbers come in.
Don't forget to hit subscribe if you enjoyed this breakdown.
And definitely check out the StockOracle 14-day trial link in the description to run your own scenarios on ZIM's catalysts. Until next time, keep diving deep.